give anybody that is participating in the right way, take note of that, in the right way to give you your deserved profit and to give you the level of financial freedom you are looking after. All right. So, and I went further. I talked about the market participants. I said, who are the market participants? We went further to discuss that one of the first market participants of the Forex market are the government. Because of the government, because of the big banks to the hedge funds. And I'll give an example of how the government participates. Sometimes the government can decide to put money in the foreign reserve. They also they buy foreign currencies in terms of major projects. This is how the government also trade in the Forex market. But the government participant in the market is not majorly for profit purposes. They just do it because they want the market to be flowing. And by doing that, the government is also maintaining the interest rate of its and inflation of its one economy. That is why the government also is necessary for them to participate in the Forex market. Now, I went further to let you know that the hedge funds and the big banks also participate. Who are the hedge funds? Who are the big banks? There are banks that are large, the World Bank, the Swiss banks. These are banks that are big. They are the bank of all banks. These banks also participate in the Forex market. Then we have the hedge funders. The hedge funders are fund managers. These are fund managers. I gave an example of a very classic hedge funder is Warren Buffett. Warren Buffett is a hedge funder and he owns a big conglomerate in financial industry. All right. So then further, we talked about after the hedge funder, we'll now talk about the retail traders. And I
Hello, sir. Are you there?
I can't hear him as well. I guess it's network.
Yes, I think so. I'm sorry, guys. Let's just give him some few minutes. I think his network is having some challenges. Please.
Okay, ma.
Thank you. Thank you so much.
Hope I'm not lost now. Answer. I'm not hearing anything.
No. Yeah, I think his network is having issues, so we're actually waiting for him to come back online.
All right.
Thank you. So sorry.
Hello, can you hear me now? Hello.
Yes, I can hear you.
Yes, I can hear you.
Yeah, we can hear you now. I'm sorry. I'm really sorry today. The network, I guess, is the network that is causing this. All right. I'm using MTN. I don't know why it's misbehaving. I'm so sorry. Okay, now let's proceed. Like I was saying, so these are the participants in the market, and I told us that today we'll be talking about some basics of the forex market, and I brought about some terminologies that we'll be discussing, and one of them I talked about currency pairs. All right, and I said we'll be talking about currency pairs. We're talking about leverage, be long stroke short. We're talking about margin. We're talking about PIP. We're talking about lot size, bullish stroke bearish, trend, going long stroke going short. So these are the things, the terms we are going to be talking about today. All right. So now I'm going to continue with first. We're talking about the currency pairs. We talked about the market participants. Now I've told us who the market participants are. All right. You and I, we are the retail traders. We are those that are involved in the market. We trade in the market. So we are those that are involved with the hedge fund, the government, and the banks, the commercial banks, and the big banks. We all are the market participants. Everybody that goes to the forex market has a reason why they are going there. But for the retail traders, we are classified under the group of the speculators. Our major aim is to make profit. And now, what are we doing in the market? When you are going to the market in your physical home, you go to the market for a reason, right? You want to buy, and you want to buy or you want to buy and sell. Exactly, that is what we do in the forex market. As speculator, when we go to the market, we are looking for opportunity to buy financial assets, all right, or known as currency. Financial assets. Now, these financial assets are classified into four. All right. One, we have the forex. All right, the forex category. We have the stocks category. We have the bond category, and we have the crypto category. Stocks through shares. All right, category, the bond category, the crypto category, and the forex category. Now we're going to be focusing on the forex category. In terms of the forex category, what we buy there are called currencies. Are you with me? Hello? If you're there, I want you to say hi.
Yes,
Hi,
I'm with
hi,
you,
we are
sir.
here.
All right. So what we are after in the market when it comes to the forex category are called the currency pairs. Currency pairs. Now, these pairs, we call it currency pairs because you cannot trade a single currency. For example, say you want to trade. For example, you are looking to trade Naira. You cannot trade only Naira. You buy one currency to sell another. So they go in pairs. For example, a very popular example pair in the forex market is Euro USD. Euro stands for Europe currency. Like we all know, we are all aware of Euro. All right, that is the currency that you use in Europe. Okay, why USD is the currency of United States of America. Now, these two currencies in the forex market are known as Euro USD. or we are known as a single currency pair. All right. So now, what you do with this pair is that if you are buying one, you are selling one. So the essence of this pair is that as a trader, you are looking at the possibility that one will be rising against the other. Okay. Now let's assume you have conducted your financial analysis in the market, which we are going to be, which is the reason why we are learning this skill. Your aim of this business, of this lesson, is for you to be able to know when to say, euro will be strong against the USD. What I mean is that at so day or this moment, I am confident that the euro will be very strong, while the United States dollar will be very weak. All right. So if you have done a forecast on the financial market based on facts that you have come up with, and then you go ahead and buy euro, if your forecast goes in line with what your decision, guess what? Really, the euro will gain strength, while the United dollar will go weak. And by the time this happens, guess what? You will be in profit. All right. So what will trade in the forex market are called currency pairs. I hope that's clear. Examples include euro USD, all right, euro JPY, these are currency pairs, GBP USD. When I mean GBP, British Pound United States Dollar, euro Japanese yen, these are classical examples. All right, USD, AUD, USD. All right. We have a lot of USD card, United States dollar versus the Canadian dollar. So whenever you see this, although I'm not using a board right now, in our next class, I'll be able to be showing you how these codes appears on your trading chart. Okay. But for now, I have this information that what you trade are currency pairs, and these pairs, they go one against each other. All right. Now, in this currency pairs, we have the pairs we call the exotic pairs, and why the one we call the major pairs. Okay, now we have the major pairs. Sorry about that. We have the major pairs, we have the minor pairs. Are you with me? We have the major pairs and we have the minor pairs. And we also have crosses, or known as exotic pairs. Which of these pairs are known as major pairs? The ones that are known as major pairs, they are 4 in number. They are the currency of the strongest economies of the world. One is the USD, British Pound, Euro, and Canadian dollar. Are you with me? British Pound,
Yes,
United States dollar, Euro, and CAD. These are major currencies of the world. Now, any other currency that is attached to them, they are called the major pairs. For example, each of these major pairs are the pairs that form the base. Are you with me? There's one we call the base, and there's one we call the quote. The base and the quote. The base are usually on your left, is the one that is written first before the next. For example, if I want to call Euro USD, all right, the one I pronounce first is called the base currency, while the quote is the USD, which is the United States dollar. So the one to the left is known as what? I want you to repeat with me. The one to the left is known as what?
base currency.
The base currency. While the one to the right is known as the quote currency. Are you listening to me? Are you with me there? All right. So the first one that you call, anytime you want to call a pair, a currency pair in the market, is called the base. Why this? The last one is called.
So I think your hands up is blocking your camera.
is called the quote. All right? I hope that's clear.
Yes.
I hope that's clear. All right, so we have the minor currencies as well. The minor currencies are the currencies that are not paired with the major currencies. Are you with me? For example, we have the NZD JPY, CHF card. These are what? Minor pairs. We have the minor pairs, which are the normal pairs of other currency. For example, the New Zealand dollar, the Australian dollar. These are called minor pairs. I hope that's clear. Then which ones are called the exotic currency? The exotic currencies are the currencies of the third nations. For example, the Nigerian currency. If you pair any third nation currency to any of these minor or the major pairs, they are called exotic currencies. I hope that's clear. For example, the South African rand against the US dollar is an exotic pair. The Nigerian naira against the US dollar is an exotic pair. All right? The Ghanaian cedis against the US dollar is an exotic pair. So exotic pairs are the pairs that contains either the major or the minor pair in line with the third nation currencies. These currencies are called exotic pairs. I hope that's clear. All right, that's all about the currency. And these currency pairs are represented with a price. And this price is called quote. I hope that's clear. It's represented with a price. Remember, I told us when we were talking about the market in our first class, we talked about the definition of market, saying there are three major factors that makes any particular setup or meeting between people, call it a market. And one is called the buyer, the seller, and the price. I hope that you remember that. The buyer, the seller, and the price. So whenever there is a market, there must be a buyer, there must be a seller, and there must be a price involved. Any transaction
Is it
I
me?
can't hear you, sir. You are muted. You are muted, sir.
okay, all right, can you hear me? And I told you that when you are buying any currency pair, you are buying one to sell one. Now, for you to buy one to sell one, there must be something you must use to determine whether you are to buy this. And if you are buying this, the time and what you are buying. And that is what the price. That is the price. So this price that is tied to any currency pair is known as what? Quote. They comes with decimal numbers. For example, Euro USD is majorly quoted as 1.025, 1.11234, just like that. All right. These are called quotes. So the number that's attached to any currency pair is called the quote. And this quote is usually in two. It's usually two. Are you with me? It's usually two quotes that is attached to a currency pair. And that will lead me to what with our next common term called the ask and the bid. And the bid. Are you with me, guys? If you're with me, say yes, right on. The ask
Right on.
and the bid. I hope you're writing. Even if I'm not using a board now, please make sure you are taking note of what I'm saying. The ask price and the bid price. All right. Now, what is the ask price and what is the bid price? Every currency pair, like I said, has two currency. Every pair is made up of two country currencies. The first one is called the base, while the second one is called the quote. Now, each of these currencies make up a pair. Now, this pair carries a quote. Now, this quote is also in two. The two price is known, the first one is called the bid, while the other one is called the ask and the bid. Sorry, the first one is called the ask, the bid price, and the ask price. We have the bid price and the ask price. What is the bid price? The bid price is the actual price in which this currency pair is being traded in the market, in the forex market directly. Now, between you and the forex market, there is a third party, and that party is called the broker. Are you with me? The third party is called the broker. What is the function of the broker? The broker is the one that brokers this transaction between you, who is the buyer or the seller, and the market. That is so the job of the broker is to make sure that he makes you have access. I'm rephrasing, makes you have access into the financial market to conduct this transaction. Now, they are the one that brings the price to you. When they bring the price, the actual price to you, they also have another price they attach to it, which is like a contract. It's like a commission. Just like for example, if you are into this, like you are into real estate or you sell land and all kind of stuff. Sometimes you discover that after you have sold the land, you earn a commission, isn't it? If you've sold the land between you and the buyer and the seller, you are the one broking between the buyer and the seller. And once you are done with that deal, what happens? Automatically, you earn a commission. They pay you a commission. The commission will depend on what you agree with the sellers and the buyer. Sometimes some people say 5%, some say 10%, as the case may be. All right. Now that price that which they pay you as commission, that is the one we known as what? The ask price. Are you with me?
Yes.
The commission price is the ask price. Why is the bid price. Why the ask price is the actual price from the market. All right. So these two price is called the ask price and the bid price. Now, this is what the broker that brokes between you and the market, this is what they use to earn or to reward themselves for rendering these services to you, which is called the commission between you, they earn it from you and the market. I hope that is clear. So those two prices, so any pair you see comes with two prices in the financial market. It comes with the bid price and the ask price. Take note of that. I hope that is clear. I hope that is clear.
Yes, sir.
Now we are going to talk about leverage. We are going to be talking about leverage. That is our next point. What is leverage? Leverage, like we all know, is like let's say you want to buy leverage simply means buying something that is worth 100 million naira, but you just have 10 naira. Let me put it that way. You have 10 naira, but you are able to purchase 100 million naira worth of goods because of the leverage that was given to you. So leverage simply means borrowed money. And who gives you this leverage is your broker. Your broker gives you leverage in the market. Take for example, most of the retail traders, most of us, the challenges we have most cases after you have learned this skill is a fund. You know, in the forex market, you're talking of for you to make reasonable money, you are looking at raising good capital that you'll be using for your capital to fund your account. Now, this particular account, sometimes our brokers understand that to raise this fund is not just easy for retail traders. So what they do is that because they want you to want to be in the market, because for you to be able to take one transaction in the forex market to buy one lot, you need to hold a minimum of $100,000. You get me? But they understand the fact that not every trader can afford that. And with $100,000, you can only buy one lot. And that one lot, with just one lot, it will be very difficult for you to really be making something reasonable in the forex market. So what they do is that they come up with the possibility of what giving you money in form of what leverage. Now, these brokers over the years, that is why for you to be able to run a brokerage company, you would have the CEOs are people that have good money. So they have money that they launch as backup to the IMF. Just as, for example, in Nigeria here, we have other banks like the Zenith Bank, the First Bank, the GT Bank. And these banks, before they are allowed to operate, there is a certain amount of money they keep with the CBN. Now, this money is like a security for the participant, for the customers. You get me? And that enables the customers, they can do anything. They can even give out loan and the rest with other people's money with no issue. All right. So also this also happens with the brokerage company. So they have this money, and because of that, they are able to lend you certain amount of money in form of leverage. That is why anytime you're going to be signing up now with any brokerage account, you see them, they give you leverage. Some of them, they will say 1 to 2, 1 to 3, 1 to 4, depending on the company. Some will say 1 to 100, 1 to 200, 1 to 50, 1 to 1,000. Some say 1 to even unlimited leverages are there. So what this means is that if you, for example, you select 1 to 1,000, it means out of $1 you have, your $1 have been multiplied with 1,000. It becomes how much? 1,000. So with your $1, you can take a trade that is worth 1,000 units of trade. Why? Because of the presence of what? Leverage. So leverage simply means borrowed money. Your broker borrows you money to trade. Now, most people now ask, why would a broker borrow me money? Why? Even when, because you know why? Because the brokers make money when you trade. Because your brokers make money when you are active in the market. Remember, I talked to you about the bid and the ask price. Between the difference between the bid and the ask price, that is the broker's commission anytime you place a trade, and it is debited instantly from your account.
We can't hear you again, sir. Sorry, guys. I think network has kicked him out again.
Thank you,
Let's
ma'am.
just wait for some few minutes and probably try to even start rounding up since the network is really really bad today.
Hello, guys.
Yes, I'm here.
All right. So unfortunate. I'm sorry about that. All right, let's continue. Like I was saying, so the leverage is given to you by your broker because they want you to be very much active in the market. Because the more trade you take, the more money your broker makes. I hope that's clear. So leverage simply means money borrowed to you by your broker. But the irony is that leverage is like a two-edged sword. What it means is that because you have a leverage of 1 to 1,000, it means if you deposit $100, your $100 is multiplied by 1,000. What that means is that you are having $100,000. Now, that doesn't mean that it means you can take a trade that is worth $100,000. But what if this trade is running against you? They give you the money, but if the trade is running against you, broker's money will not be taken, but only your money will be the one that will be taken. They will withdraw their leverage, and then once your money, your capital is low, you will get what we call margin call. That takes me to the next point called margin. Are you guys with me? Our next term we are looking at before margin. What's your margin? Margin is the actual money that you have to hold your trade running. That is your margin in the market. Now, when you place a trade, you discover that the trade that you place, all right, will show you the number of trade you have taken. If you look at your MT4 or your MT5, under that place, you're going to see your equity and you will see how much that is left from your capital that you can use, because with the help of the leverage that you have, that you can use to take more position. All right. And how much that will be left if the trade is running against you. There will be a time your margin can run to positive or it can be negative, depending on whatever that is the outcome of the trade you are taking. Most times, once your trade is in profit, your margin increases. It increases by percentage. Why once your trade is running against you, your margin can go negative. In fact, when it's running against you, depending on if you are not over trading, it will be reducing as your trade is going against you. So a time comes, it goes to negative. And most times, if that trade is not liquidated by you, either through your safety net or any other means, or direct losing the trade, it can lead to what we call margin call. And what is margin call? Margin call is given to you by your broker once your money is almost exhausted, that you no longer have balanced capital to hold that trade further. So what they do is that they send you a margin call, either via your email or through your phone number. They send you a margin call. The essence of the margin call is for you to either add more funds into your account or exit the trade. And in circumstances that you fail to exit it, they will help you to exit it. And at that time, by the time a broker is exiting your capital is already zero. I hope that's clear. That is what we mean by margin call. Hello, are you there with me? If you're there, say hello.
Yes, I'm here. Yes, sir.
All right. So the next point we are going to be talking about is called the buy and the sell, or going long or going short. I'm going to put them together to talk about it. Or the bulls and the bears. These are the three terminologies. These three terminologies I mentioned, they are used interchangeably. They are all standing for almost the same thing. So what does the bulls mean? What does the bears mean in the market? It's a common term used by traders. Now, once as a trader, you heard somebody say bulls. The bull means those that are going to buy, those that are buying in the market. I hope that's clear. Bulls stand for those buying in the market, while the bears stand for those selling in the market. Take note, the bulls stand for those that are buying in the market, while the bears stand for those that are selling in the market. I hope that's clear. What does it mean to say go long or go short? If I say go long, take for example now, and maybe I have a trade, and in that trade I say go long. What it means is I am asking you to buy the trade. So anytime you hear me say go long, I'm telling you to buy. So going long means buy. Why going short means sell in the market. Is that clear? Going long means buy. Going short means sell. Short, S-H-O-R-T, short, going short, all right, means sell in the market. Just as the bulls means buyers, the bears means sellers. Going long means buy. Going short means sell. I hope that is clear. So to buy simply means to go long. Why to sell simply means to go short. So these are the three words. This is how they are used in the financial market. Is that clear? Any question before I proceed? Any question? If you have any question, please ask me before we proceed. We have limited time. Very soon we'll be running off this class. The time will not be able to finish up this basics today, but I'm trying to see how we can pick up either one or two other topic and then we call it a day. Hello? Any question? Someone having a question, please ask me. Hello? In fact, this is already small. I had a lot of activities during the day that really did not allow me, really did not give me the time, the needed time to prepare and get all these my devices ready properly for this meeting tonight, this evening. But all the same, I promise you in our next meeting, it's not going to be like this. Any question, please? Any question? Any question? Are we there? Are we there?
Yes, I'm here.
Oh, any question?
Yes, sir. Yes, sir.
You have a
Does it mean, let's say,
You can.
let's, let's say you have, I want to talk about the margin. I want to ask you about the margin.
hello?
Let's say you have like 100K for your
I
capital.
can't hear you. Hello?
I want to ask a question on the margin, on the margin.
Margin.
Yes.
Okay.
So what I want to ask is, let's say you have like $100,000 for your capital,
Yeah.
and now the broker now extend it to like 100 million. Does it mean that once you either you buy or you sell, once the trade turn against you, does it mean that once your $100,000 finished, that is what will cut? It will not remove their own money, or it will continue like that?
Yes. Once, as regard, I've told you that the leverage they give to you, they gave you leverage, like they borrowed you money. Now you decide how much you are going to take from the money they borrow. Some broker even go as far as giving you unlimited. Like they can borrow you all the money they have. They call it unlimited. Some brokers have unlimited. Some can give up to 1 to 2,000 leverage. For example, one of my broker uses 1 to 2,000 maximum hot forex. All right. So what it means is that, for example, if you deposit $100,000 and you selected when you were creating the trading account and you select 1 to 2,000 as your leverage, it means your $100,000 is multiplied by 2,000. Are you with me? Hello, can you hear
Yes,
me?
sir.
Yes, sir. Yeah, it is multiplied by 2,000. So what you have, that is the volume, that is the capital that you now have in the market. But some part of that capital, you are not going to see it reflected on your deposit because it is leverage. The only money you are still going to see in your deposit is that 100,000. But without 100,000, you can take, let's assume you multiply it, it's giving you $200,000. You can take all trade that is close to 200 up to $200,000. But guess what? If you now decide to take high risk because you know you have high leverage and that trade is running against you. Now, it doesn't mean that the moment the trade is running against you, that is when you get a margin call. No. Take note, once the trade is running in your favor, the leverage will help you to make more profit. And whichever profit you make, the broker does not share it with you. You get all the profit to yourself. The only thing the broker gain is the commission, which is that difference between the bid and the ask price, like I have taught you earlier. But in scenarios whereby this trade is running against you, and it gets to the level that your money is almost getting to finish, the broker will withdraw their own leverage. Because that leverage is their own capital. They will not allow you to lose your own money along with their own money. They are after protecting their own. Are you with me? So any trade you are taking, if you take a loss on that trade, even if you take that trade with the leverage that is backing up your account, the loss that you took will only be reflected on your capital. Are you with me? I hope that answers your question. Hello? Hello? Hello?
Hello, Daniel. Are you still there? I think he has gone off. Like the network has thrown him out.
Maybe it's network. Yeah, I guess it's network. So that is that for that for Mr. Daniel. I pray he comes back. All right. Any other person with any question? Any other person? If you have any question, please ask us. Hello. All right. In the absence of question, let's go further and take one more terms, and then I will call it a day. And in our next class, we will continue on this topic and then probably enter another topic. All right. The next one now we are going to be talking about is called, let's talk about the trend. Because we just talked about buying and we talked about selling. Now, what is trend? Trend speaks about the direction, the prevailing direction of price in the financial market. The current prevailing direction in the financial market. That is what trend means. Just like today, if you go to coastal areas, for example, if you go to Lagos Beach, you discover that you see that the wave of the water move to certain direction at some certain time. You get me? That is how also the market also have waves. The market have waves, and these waves is determined by the participant and the economic circumstances that is happening currently in the market. Now, this market can take three decisions. One, price can decide to be going up or going down or sideways. This process where price either go up or go down is called trend. I hope that is clear. The time price is going up or buying up, buying, we call it trend. Why when price is going down, also going down, it's called trend. Now, this trend, all this I'm doing is just an intro. We are also going to be talking about this trend in detail when we get to intermediate. So we're going to be discussing in details what trend is, how you can identify trends, and how you can apply all these things in your trading analysis. Okay, so but just take note that trend simply means the prevailing direction of the price with time. At a given time, the prevailing direction of price at a given time is the price going up or going down at a given time. That direction is going is called the trend of the market. Then we also have what we call range. What is range? Range is when price is making equal highs and equal lows. It moves up, it goes down. It goes down, it goes up. That is, it's going sideways. So in that market, we call it a sideways, a range market. Why a market that is moving at a particular direction is called a trend market. I hope that is clear. I hope that's clear. I hope that's clear. It's called a trend market. Now, how do we identify trend? There is a tool we use for trend identification, and that tool is called trend line. Trend line. Trend line is the tool we use to identify trend. Okay? All right. The next point we are going to be talking about after the trend is called time frame. Time frame. Now, what is time frame? You know, everything in life is revolves around time. That is also how price in the market revolves around time. So in the market, in the financial market, we work with time. That is why we have what we call market sections. We have market sections in the market. In fact, today we are having three major sections in the market. We have the New York section. Okay, the New York section is the opening of the US market. Are you guys with me? The New York session is the opening of the US market, and that is about the 8 a.m. hour of the US. In Nigeria here now, currently, it is by 1 p.m. At 1 p.m., that is when the New York session of the Forex market opens. Because at that time, it is 8 a.m. in US. It's just like the time where business activities is resuming for the day in US. So that time is 8 a.m. in US. Why in Nigeria time is 1 p.m. So take for example, you are a trader, you want to trade the New York session. It means that you are going to be looking at to enter the market by 1 p.m. in the day in Nigeria. Are you guys with me? Hello? If you're with me,
yes, I'm with you.
All right. So the time in which you are entering the market is very also important. So we have the New York session. All right. We have the London session. We have the New York session. We have the London session. And we have the Tokyo session. As I speak to you now, I think we will soon enter the Tokyo session. The Tokyo session and the Asian session, they overlap and they work together as well. All right, we have the Asian session, the Tokyo session, the London session, and the New York session. These are the major sessions in the market. All right. Also, apart from these sections, okay, now let me tell you that of London session. The London session with Nigeria time starts by 9 a.m. Are you with me? The London session in Nigeria time is 9 a.m. in Nigeria. That is when the London session begins. While the Tokyo, so the Asian session start by 11 p.m. 11 p.m. Sometimes it can be like 10:30. Most times 10:30 or 11 p.m. That is when the Tokyo and the Asian session opens. All right. And also in the chart, we have what we call different time frames. We have the 1 minute time frame. Okay. We have the 2 minutes time frame. the 3 minutes time frame, the 5 minutes time frame, the 10 minutes time frame, the 15 minutes time frame, the 30 minutes time frame, the 1 hour time frame, the 2 hour time frame, depending on the app you are using for trading. Then you have the 4 hour time frame, you have the daily time frame, and you have the weekly time frame, the monthly time frame, and the yearly time frame. Each of these time frames have their different impact. Each of these time frames have their different time impact on the trade that you are taking or influence on your trades. Okay, so these are the major time frames we have in the market. If you are using a device called MT5 or MT4, when you open it, you're going to see 1 minute time frame. You're going to see 5 minutes time frame, 15 minutes time frame, 30 minutes time frame, 1 hour, 4 hours, daily, weekly, and monthly. If you go to other platforms like the Trading View, you are going to see all type of time frame. You're going to see 1 minute, you see 2 minutes, you see 3 minutes, you see 4 minutes, you will see 5 minutes, you will see from 5 minutes, you will see 10 minutes. From 10 minutes, you see 15 minutes. From 15 minutes, you see 30 minutes, 1 hour, 4 hours, 2 hours, 2 hours, 4 hours. Then you go for daily, go for weekly, you go for monthly, and then yearly and range. All right. So these are different types of time frames we have in the financial market. All right. With this, I've come to the conclusion of our meetings today. So I want to clear the house and expect that you have any question and ask me. Hello. Any question, please?
None from me.
Any other guys? Mr. Siri. Any of you?
Please, if you have any questions, feel free to drop it either on the chat or on the platform. On the platform.
We attend to it right away. It's good you ask questions. When you ask questions, then you understand better. Please, there's anything you are not clear of from all that we have discussed today, please, or in our previous class, feel free to ask. All right. All right. Since there's
All right. Thank you so much.
So
I
close up the section for the day.
Thank you. Thank you so much, Mr. Roland. We really appreciate your time. So we'll be seeing you again in our next class, which is Saturday evening. Thank you, everyone.
All right. Thank you. And good night, everyone.